Welcome to the Friends with Money podcast, brought to you by Money Magazine, creating financial freedom for Australians since 1999.
Hello, and thanks for joining us for another episode of Friends with Money, Money Magazine's podcast to help you earn, save, and achieve your financial goals. My name is Tom Watson, a senior journalist here at Money Magazine, and as always, it is a pleasure to be with you. 12.6 million. That is the number of individual tax returns the Australian Taxation Office, commonly known as the ATO, says it has received for the 2023-24 financial year as of late January. And I know it's hard to believe, and frankly, some of you won't want to hear it, but with the end of the financial year nearly upon us, it is time for Australians to start thinking about tax again in a serious way. So with that in mind, on today's episode, we are going to take a look at some of the things that taxpayers can do before this financial year is out, and once the 2025-26 financial year begins, to prepare for tax time. And joining us today is a man that always has tax on his mind, or actually, I hope that's not true for your sake, Mark, but it is a regular Money contributor, friend of the podcast, and director of tax communications at H&R Block, Mark Chapman. Mark, welcome back to Friends with Money. It is a pleasure to have you back on the show.
No problem, Tom. Thanks very much. It's always a great pleasure to be here.
Mark, to start off, just to give everyone a little bit of context, what are some of the, key tax-related dates coming up that Australians will want to be aware of?
Well, the main one is coming up to tax time. Hard to believe it's been a whole year, but nevertheless, we're coming up to the season when people do need to prepare their tax returns. So as of July the 1st, basically the ATO will be open for business for people's 2025 tax returns. So they do need to lodge those as of July the 1st. Probably best if they wait a couple of weeks to lodge their tax returns. If they're relying on pre-filled data, for example, that's often not available in the early part of the tax season. So we do recommend that people do lodge from about the 14th of July onwards. And basically, they've got until the 31st of October to actually lodge. That's the deadline for self-lodgers. If they're using a tax agent, however, they potentially have until the 15th of May next year. So they have a good long time to actually lodge their return. Obviously, if they're expecting a refund, as many taxpayers will be doing, we do recommend that taxpayers lodge sooner rather than later. So, in July and August, we expect to get lots of tax returns producing very large refunds.
Well, lots of incentive to get organised and then to get filing early, although, as you said, not too early there, Mark. Before we get into some kind of practical things people can do to start to prepare, are there any groups of taxpayers that the ATO has, put on notice so far this year that, might get a little bit of extra close attention this year?
Yeah, well, the ATO's hit list, as it were, is pretty similar to last year. So they're going to be paying close attention to work-related expenses. In terms of those deductions for working from home expenses, claims for work-related clothing, motor vehicle claims, all of that kind of thing. The ATO estimates that there was something like an $8.7 billion shortfall between the tax that individuals were expected to pay and the tax they actually are paying.
Wow.
And now the ATO believes that tax gap is predominantly related to work-related expenses. So the ATO are inevitably going to have a very large focus on work-related expenses. However, in addition, if you own a property, you can expect to receive a certain amount of ATO scrutiny. The ATO recently announced that in a series of audits, they found errors in 90% of returns reviewed, which were related to properties. So therefore, you can expect them to particularly focus on investment properties, holiday homes, etc. All of those sorts of claims. And also in relation to the sharing economy. The ATO believes that there are lots of people who are operating in the sharing economy, Uber, Airbnb, Airtasker, etc., all of those platforms, who simply aren't declaring their income. So, the ATO does have a real focus on the sharing economy and indeed also on cryptocurrency. Many people believe that cryptocurrency provides people with an opportunity to buy and sell with some degree of anonymity. They believe that the HEO doesn't know what they're doing. Well, the HEO, by and large, does know because they're getting third-party data from cryptocurrency exchanges, and therefore, they are going to have a real focus on people who are investing, buying and selling cryptocurrency.
I'm sure there's been a lot of people that have been doing that, especially in the last year or so. So a good little warning there for them and the other people that you mentioned there, Mark. All right, let's get practical then. Are there any last minute deductions or contributions that people may want to consider making now before the end of the financial year actually comes?
Yes, well, probably the biggest one is asset write-off. Now, that only applies if you're running a small business. So if your small business has got a turnover of less than $10 million, asset write-off enables you to write off the cost of all capital purchases up to a limit of $20,000 per item. If you spend the next few weeks purchasing capital items, you can write off the full cost in this tax year, provided the cost of the asset is less than $20,000. So this is a really worthwhile scheme. It was originally expected to end on the 30th of June 2025. It's actually been extended now to the 30th of June 2026. But nevertheless, in this current tax year, it does provide a great incentive for small businesses to do some tax planning, particularly last-minute tax planning around this time of year. So that's only applicable to small businesses. If you're employed, there are various other things you can look to do, such as making a tax-deductible super contribution, provided the total amount of your concessional contributions doesn't exceed $30,000. This can be a great way to both boost your retirement savings and also claim a tax deduction for the personal contribution. Now, that $30,000 does include any employer's contributions, which have already been paid. Nevertheless, there might be some additional contributions that you can make in order to meet that $30,000 threshold. So if you can, if you've got some spare cash lying around, that's well worth looking at.
Yeah, great point. Always love the idea of making an extra contribution. If, as you said, you have the cash to spare, it could be really useful. Mark, just a bit of a follow-up on this one. How can people ensure that they're actually, claiming the deductions that they're entitled to without getting in trouble with the ATO?
Well, the best plan here is really to get a tax agent. A good tax agent will be able to sniff out some additional deductions that you may not have realized that you're actually entitled to. But equally, a good tax agent will be able to say that, no, you can't actually claim this deduction. So, they do earn their fees in both directions. And of course, the tax agent's fees itself deductible in next year's tax return.
And still on the kind of end of financial year to-do list, or perhaps kind of moving into post as well, are there any documents or records that people may want to start putting together, to make life easier when they actually start thinking about preparing their tax return in the months to come?
Yes, well, in terms of substantiation of your deductions, it is necessary to have all of your invoices or your receipts. So it is worthwhile spending the time now to pull together a folder, either in electronic form or in paper form, of all of your receipts to support the deductions you intend to claim. Even if you're not sure whether it's going to be claimable, get the receipt or the invoice, take it along to your tax agent, and they'll be able to tell you whether you can claim it or not. Now is a really good time to do that. Obviously, if you can't find a copy of the receipt or the invoice, you have the option of potentially going back to the retailer and obtaining a copy. Otherwise, unfortunately, you won't really be able to claim a deduction for that particular item if you can't substantiate it. So in other words, if you can't produce the invoice or the receipt. There are certain circumstances where you might be able to get away with a bank statement or a credit card statement, but that isn't guaranteed. So we always say that an invoice or the receipt is the the primary form of substantiation. So it is essential that we go into tax time, with a comprehensive file of invoices or receipts for all of our clients.
Don't want to pat myself on the back too much here, but one of my kind of financial New Year's the resolutions last year was to keep a proper folder in my Gmail and chuck all my kind of work-related expenses and receipts in there. So I've got a nice, tidy folder ready to go for tax time this year, and I've actually followed that. So, well done me. I don't know why I brought that up, but yeah. I think it's a good idea. Anyway, Mark, let's move on to the new financial year then. After July 1, when the new financial year begins and people can, as you said, in theory, start to think about their tax returns, is there anything they should consider or, straight out shouldn't consider doing to, make life easier or not?
Well, I mean, thinking forward to next year's tax return, it might seem that we're a long way from that point. But doing what you did, storing documents as you go through the course of the year will always make life easier come tax time. It's all very well scrabbling around trying to find invoices in June that relate to, last July or August. But it's so much easier if you've actually had the forethought to actually pull together all of those invoices at the time at which you spent the money. So therefore, it is worthwhile preparing a file and actually filling it with invoices or receipts as you go, rather than trying to do it all at the last minute in June, when there's a good chance that you won't be able to find a receipt for a particular invoice. You're potentially missing out. That is probably the number one key. Think ahead and plan accordingly, and keep your receipts and invoices as you actually spend the money.
Follow my advice, dear listeners. Not that I give any personal or financial advice. That is only general advice. Mark, final question for me, and with the caveat that things could, always change between when we're recording this episode and the start of the new financial year. But are there any new tax-related changes kicking in from July 1 that people may want to know about?
Yes. Well, the rate of the lowest rate of income tax is actually coming down from the 1st of July. That won't be make a huge difference. It'll, amount to about $5 a week for most taxpayers. So therefore, it'll pay for a cup of coffee. But it's worthwhile bearing in mind. But other than that, basically things are carrying on much as they're expected to in a new financial year. There aren't really any major changes to the financial system, to the tax system. Obviously, with the caveat that things can change with the economic climate, the way things are at the moment, things may well change. But as we speak today, there aren't really any dramatic changes to the tax system that people need to be aware of.
Well, given the turbulence that we've been witnessing over the past couple of weeks and even months, I think everyone would like a little bit of stability, even if that means nothing too exciting on the tax front in terms of changes from July 1. Mark, I think that's probably an excellent place to wrap things up for today. So thank you so much for joining us, as always, and I'm sure we'll look forward to hearing your voice on the podcast again very soon.
It's a pleasure. Thanks, Tom.
And before I forget, if you'd like another quick tax fix and you haven't listened to it already, can I recommend our episode with Mark on inheritance and tax, episode 190. It is a thoroughly engaging episode and it's had a great response so far. So we very much appreciate everyone that's given that a listen, and of course, Mark himself for doing such a stellar job on that episode. Anyway, it is a time for me to stop talking because that is it for this episode. But don't forget, you can always jump on our website, moneymag.com.au, for your daily dose of financial news, or you can go grab yourself a copy of the latest edition of Money Magazine in all good newsagents. As always, Friends of Money will be right back in your podcast feed next week. So until then, my name is Tom Watson. Goodbye for now.
Thanks for listening to the Friends with Money podcast. For credible, independent, and easy to understand financial commentary, visit moneymag.com.au. Please remember that the views and opinions expressed in this podcast are general in nature, and further independent advice and research based on your personal circumstances should be sought before making an investment decision.